Mic check 2, test, test, mic check 2.
Southwest has its place. My old boss used to work fishing. Come home fishing for the
There. I don't know. It must have like a little glitch in it or something.
I think we've got a few folks still coming in, but we should probably go ahead and get started. Good morning, everyone. Thank you. That was a much better try the second time. Really appreciate your willingness to spend the morning with us. There is some tradition associated with this forum. I think many of you know this is the University of Oklahoma Foundation's way of sharing with all of you what's going on in the foundation, especially in the two principal areas where we have the biggest opportunity to add value to the University of Oklahoma: our fundraising efforts and our investing operations. The very best. I'm Guy Patton. For those of you who don't know who I am, president of the University of Oklahoma Foundation. And what I say with that title is that, it's good because it keeps me off the street at nights mostly. But the very best part of what I get to do every day is work with an exceptional group of colleagues. I'm in a lot of ways, we are truly best by the level of talent that we have throughout the organization. And of course, and the folks who will be familiar to you in today's meeting as well. But the quality of our organization is a function of the quality of the people that we have working there, and I'm blessed to be able to work with an outstanding team. You're going to get to meet or hear from three of those today. We'll kick off with Amy Noah. Will give you an update on what we've been up to with regard to fundraising, and the answer is a lot. She'll dig into a little bit more detail around that and the success that we're having there, which is absolutely critical, obviously, for the university. She'll then turn it over to Brad Johnson, our Chief Investment Officer, who will give you an update on our activities, mostly within the endowment portfolio, and that'll transition to Gene Lohmeyer, Brad's deputy, in terms of what's going on in the capital markets. And then at the end, as we usually do, we'll open it up for questions. So I'm going to get out of the way and get to the good stuff. So with that, I'd like to introduce Amy Noah, our Chief Advancement Officer, and she'll talk about what's going on in fundraising. So thank you.
That's right. Guy knows I'm a hugger. So thank you guys for joining us. As Guy mentioned, this is an opportunity for us to get together once a year and try to highlight some of the work that's happening. There's a lot, as he described. I apologize. We couldn't do better weather-wise, although it looks like it might clear up. I just was happy that the weather didn't elevate itself to a David Payne moment this morning. So at least you all chose to join us and not watch the animation that appears on TV with David. Okay, so hopefully you can see this in the back. What I really wanted to do is give you a highlight about the work that's happening around fundraising, and take a moment to celebrate the accomplishments that we've been able to achieve so far. Certainly, it is not lost on us that our success is a reflection of the commitment and the dedication that comes from those individuals who choose to support the University of Oklahoma. And we are incredibly grateful for all of the individuals who have made commitments and continue to engage with us across the university. You hopefully know that we're in the middle of a campaign. And when I say middle, we are really, truly right at the midpoint. So we just surpassed the halfway mark of time on December 31st for the campaign. It's a 7-year campaign, and it will end on June 30th, 2027. With that halfway mark of time, we also were able to reach the halfway mark of dollars raised. Our campaign goal is $2 billion, and we celebrated in February that we had hit the $1 billion mark. So we're super excited about that. When we look at the makeup of that work. It comes from, gifts at all sizes, and we are grateful for the gifts that we have been able to secure as a part of the campaign. A couple milestones that we have talked about is with regard to some of our larger gifts. So we, so far to date through the campaign, have secured $171 million plus gifts. And many of those gifts are more than 1 million. We just count them at the 1 million mark. So that's where we're at on that front. But to speak about volume, you can see on the slide here, we've had over 300,000 gifts to the campaign so far. And we have a very small but mighty gift processing team. I'm looking to see if I see any of them here. They're probably back in the office right now, plugging away on the keyboard to get gifts entered. But we have a really wonderful team. They literally are responsible for every one of those 300,000 transactions. So we're grateful for their support. I will also share that when we look at our work, we're committed to bringing new relationships to the university and engaging with alums that have possibly not been engaged in the past. So when we talk about the 300,000 gifts, 25,000 donors have given to the campaign so far that have never given to the University of Oklahoma. And so there's a slide in here later where I'll talk a little bit about why that's happened or what we think has been certainly a factor in that. But campaigns have a way of bringing people in. They build energy and excitement, and they allow us to be hyper focused on the priorities for the university. So that's where we're at. The next slide is really a breakdown of what we're doing as it relates to student support. And I drill down to student support because when we announced the campaign in 2022, we acknowledged that our highest priority would be student support. So out of the $2 billion goal for the total campaign, we're imagining that we'll raise $500 million for student support. So we are at 256, so right around that halfway mark, and again, right where we had anticipated we would be. We have had over 25,000 gifts for student support, and many of those gifts, actually, 2,200 over 2,200 donors have given to support students at the University of Oklahoma for the first time. So it's the first time they made a gift, and it's going to go to support students. So we're really excited about the response we've seen to this. It, no matter what, if we made all 2 billion the goal for student support, it probably still wouldn't be enough to satisfy the needs. And I say that just to illustrate that the university is being very focused about growing enrollment and what does that take and what do we need to make that happen. And the reality is that we every year find ourselves in a situation where we're not able to attract some of the students who have the capacity and the intellect to be successful here because of dollars. And so for us, we know that we'll never get ahead of this problem like every university in the country, but we are committed to this being a priority. We're hoping in the second half of the campaign to have some additional opportunities to enhance this work and to give some of our stakeholders an additional reason to want to make investments in student support. So I'll just tease that out and say stay tuned, but that's our hope. When we talk about student support, we've had success around student support at all levels of the university. So there's not an area on campus that supports our students that hasn't received gift support throughout this campaign for student support. Where we've had some really significant successes are in the 4 that I've listed here. The Dodge Family College of Arts and Sciences has been just paramount in the work that they've done. In fact, 23% or 25% of their fundraising total has actually been to support students. And so I think one of the most encouraging pieces about that is also in that college, there's been a huge emphasis on undergraduate and graduate student support. And that's always a harder place for us to see success around graduate students. But this college has done a really nice job there. And that's because there have been donors that have been really focused on that. It's been a specific priority for some of our donors. The other piece there, you'll see 51 million. That is our enrollment management. That's what we'll consider more like centralized dollars in which we're trying to support Jeff Lonick and team as they interact with the families and the students who are considering OU as an option and figuring out what opportunities we can present to them in terms of student support dollars. So that's that college. The Davis Cup scholars, is the third one listed here. If you haven't followed this, OU's become a little bit of a bully on this playground. We continue to every year, in the last couple of years, get recognized as the top university for Davis Cup scholars. We have over 300 Davis Cup scholars on campus that have been here, and so we're really grateful for this work and this support. And then, of course, engineering has also played a critical role. Engineering is one of the colleges in which we've seen a growth in enrollment, and they're continuing to fight those challenges in which it's very hard to be competitive and to get as many students and to attract those students as possible. So having these dollars has been hugely helpful for the engineering team. So this is a snapshot. As I mentioned, it's not all inclusive. We have gifts across all of the areas that have gone to support student support. So it's just a priority, and it will continue to be for the next couple of years as we close out the campaign. I mentioned earlier about first-time donors, and I will say that I think that a big part of this comes from Giving Day. If you haven't heard that we've gotten a little serious about Giving Day the last couple of years, I'll talk to you afterwards. I'll make sure that you never forget that message. For those who work with me on a daily basis, they know that this is my pet project. But we're really proud of the work that we've been able to do around Giving Day. Giving Days actually started I'd say about 15 or 20 years ago. Columbia kicked this whole thing off and tried something that really took higher ed by storm. And so what it is it's a 24-hour window of time in which we're really trying to get our message out, share news about a variety of projects and priorities, encourage people to give during that 24-hour period of time. Most of it is online giving. And so it's not going to surprise you probably, but because of those channels and those networks in which we're pursuing gifts, we tend to find a younger population of donors through Giving Day. And that's where we're seeing some of these first-time donors and some of these other trends. And in fact, this year, we had an incredible participation rate from current students and young graduates who had just graduated within the last couple of years. And you can imagine those are tough times for students to imagine making a gift or introducing them to philanthropy. So that's why we're encouraged about what we see here. I haven't shared what the goal is for next year because I really do not know. It just happened in April, and I'm sure that people have this idea that I'm going to come up with another big crazy number. That's possible, but I will say that for us to hit the 26 million, it was a stretch goal for us, and that was farther than we had imagined. When you equate that out, I mean, obviously that's about $1 million. It's a little more than $1 million an hour. And we didn't do that in every AM hour, but we consistently were able to manage that out. So a big celebration for us around Giving Day was participation. And in fact, we were most excited about the fact that this year, without being completely targeted at donors outside the domestic U.S., we were able to get a gift from 16 different countries during that 24-hour period of time. And in many cases, those were individuals who had given for the first time. So we're really, starting to look at that and think about what that looks and feels like. We also were able to secure a gift from all 50 states, and that's been an important priority for us for the last couple of years. It's always interesting. We know in advance what those trigger states are. Believe it or not, we don't have large populations in Idaho and New Jersey. And this year there was a couple other states that threw us off. So we go into Giving Day knowing where some of our tough states are going to be, and we focus on that. But truly for us, Giving Day has been a big factor in donor acquisition and bringing new people in. I do want to give a shout out. If you follow Giving Day, and if you don't, I'll describe to you a big part of what makes Giving Day successful are hourly challenges. So for each hour of the 24 hours, we have opportunities for the units who participate to win prize money. And when you think about the prize money, it could be a couple $1,000s for first place and a couple $1,000s for second and third place. And so while that may not seem like a lot to us, in some cases, it is a huge amount for the units who participate because it's truly unrestricted dollars. And everybody here, like a lot of universities, seems to have a spirit of competitiveness. So being able to compete for those dollars has been really a huge reason we've seen the success. The dollars that are made available for those matching funds actually come from the foundation and from the foundation board. So I want to give a huge shout out to the foundation board. We have 100% participation from our foundation board, and many of our former foundation board members have chosen to support that as well. So I'm super grateful for that. I know our team, if you're in this room and you're sitting with any of our fundraisers or you have relationships with any of our fundraisers, I know they will tell you personally how much it makes a difference having those matching dollars. So that's a little bit about what we've been trying to do around Giving Day. There's a lot of things happening. I could probably spend hours today telling you about all the projects and all the places in which we're trying to raise money. I selected a few for a variety of different reasons, but I wanted to highlight a couple areas in which we're really focusing some of our effort around the campaign. Hopefully, you know that we have the top flight program, top aviation department in the country here with OU Aviation. And we also do. And so we have had an incredible response to the Stevenson Cancer Center opening here in Norman. And in fact, there's a facility that's being built to support that work. But we also knew when we were looking at the Stevenson Cancer Center and the impact of the Stevenson Cancer Center, Northeast Oklahoma is a place in which we just don't have enough of a presence. And what you may or may not know is that the Stevenson Cancer Center is an NCI designated center. So it's one of the only places you can only receive access to clinical trials through an NCI cancer center. And so if your diagnosis reaches a point where traditional treatment isn't working and the next option for you is to get access to clinical trials, if you live in anywhere other than Oklahoma City, you're going to have to travel within the state to Oklahoma City to get that care. And so we announced a couple of weeks ago through a partnership, the state and the federal government have provided dollars to support an expansion of the Stevenson Cancer Center. There will be clinical trials available in Tulsa by July because of this work. It's a huge project. We're also going to build a new facility there. It's going to be on the OU Tulsa campus. And that facility has not been designed or bid out yet, but it will be available in the coming years. We'll, in the meantime, be able to do clinical trial access on the campus. But the facility that's going to be built in Tulsa, you should consider it will look and feel very much like the facility that's available in Oklahoma City. It's not just going to be a small satellite location. It's truly intended to be a large-scale support infrastructure for what we need there. So that project has a goal of $100 million that we're trying to raise. Most of that will go to support the facility, but it will also support programs and access to clinical trials and the various mobile units and the things that we need to provide that level of care in Northeast Oklahoma. So in the spirit of all things healthcare, I will also share with you that our team is working hard to raise money for the Behavioral Health Center. The OU Health announced last year that there would be an opportunity in which they're going to build a facility on the OU Health campus to support behavioral health needs. It's for young people ages 4 to 18, and it's a 72-bed facility. It will absolutely be one of the top 3-4 facilities of this kind in the country. Again, it's a project that has state support, federal support, but philanthropy is a huge part of what we're trying to accomplish here. We have a $35 million goal here, and it's a critically important part. We just expanded the ED department at Children's Hospital to support those students, or not students, those patients who have need care around mental health or behavioral health issues. And so we have added some space in our ED department there, but it's not enough. And so this facility will allow us to serve the state. I didn't know, but it was enlightening to learn that many times we have children who might be having a behavioral crisis who arrive at the Children's Hospital emergency room. And the staff there, the patients that are being seen there, oftentimes need to be referred to another service or another facility in the state. And there are very few states that can support all of the individuals that come into the Children's Hospital. So there are times where we find ourselves, OU Health finds himself with young patients in the emergency department that may end up staying in the department for weeks. They're there with a family member, they're there with a parent, and they're waiting to get placed into a facility somewhere across the state. The reason this facility has the potential to help solve so many problems is most facilities for behavioral health at the adolescent level do not provide accommodations for family. The behavioral health center that's being built at OU Children's Hospital, these 72 beds, every one of these rooms has a space within that room for a parent to stay overnight with their child. And that's really a change. That's a different model. That's a model that we've seen effectively deployed at other facilities across the country. And that's why we said it was so important, so that parents didn't have to drop off their son or daughter at a facility of this nature, but rather they could stay with them, or someone in the family could be with them for the duration of their care. So this is a project we're working on. And then lastly, I'm just going to close with a little bit of a snapshot of where we've been from a fundraising standpoint to where we hope to be. Our first fiscal year of the campaign was fiscal year 21. And you can see here we're making great progress toward what we consider to be kind of our stretch goals of fiscal year 27. But in all areas, we see our path going forward growing. I will tell you that the fiscal year 24 student support number is going to see a huge jump. We know already where we're at. We've already surpassed last year's number in large part. And so we're going to continue to see that number change. So I feel good about our ability to reach the 100 million, but it's a critical part of what we're trying to accomplish. And I just want to say a huge thanks. Many of you have personally supported the university through your own philanthropy or through engagement and in being here. And of course, I'm joined in this room with a lot of my colleagues. So grateful for everyone's support. We're excited about the path that we're on. We're encouraged by where we're going to close out the campaign, and you'll continue to hear updates from us as things move on. So with that, I think I'm going to turn it over to Brad. I think you're up. Oh, I do. Do you want me to do it at the end, or how do you want to do it? Okay, we're going to wait till the end, and then I'm going to turn it over to Brad.
Okay. As indicated on the screen, I'm Brad, and I lead the investment team here at the University of Oklahoma Foundation. And the role of the investment team is to help compound the capital of the sort of friends and alumni of the University of Oklahoma Foundation and the University of Oklahoma. And on behalf of my team, as well as myself, it's an honor to invest the capital of the University of Oklahoma Foundation. It's an absolute privilege to know that the work that we do is going to support current and future generations of University of Oklahoma students, faculty, and facilities. So racing to the end of my presentation, the two big takeaways that I would like you to walk away with are these. The foundation has committed itself to full-time professional stewardship of the investment function. We have a fully built out and professional staff that spends all of our time professionally, nights, weekends, and otherwise, thinking about how to invest and monitor and maintain the assets of the foundation. And so the pool itself, I'll talk specifically about the endowment, but the pool itself is about 2.4 billion. The endowment is about 1.9. The second takeaway is a math problem. So everybody sort of get out your calculators. It's donors plus investments plus development plus time equals profound impact. And I think it's really important that we don't lose sight of how these things come together. And so the foundation has been committed in every way to being excellent at both investing and development, so that we can take donors' capital, compound that over time, and really have a profound impact on the operating budget of the University of Oklahoma, as well as the path of future students and the success that they may have in the future. We call this collectively, we think of this as the margin of excellence. And so I pretty much say this every year, but I'll say it again. Tuition and fees is essentially the same at every university in the country. And some rack rates are higher than others, but for every public university, it's very similar. So what you can offer your students in the form of scholarships, what you offer your faculty in the form of support, what you can build in terms of facilities is really comes from something other than tuition and fees. If you want to be different than your peers, if you want to offer and maintain the margin of excellence that the University of Oklahoma has over time, it's funded in all sorts of ways, but in no small part by the generous gifts of the friends and alumni. And so, again, those gifts come to us, and it's such an honor to invest those on behalf of future generations. I'll skip the first slide since it's largely what I just covered. The investment environment that I'll share an overview here is not the capital markets. Gene will follow me and talk about sort of stocks and bonds. This is really, as you think about a team and you think about a pool of capital that's intended to sort of compound in a competitive way over time, this is the environment of which we operate in every day. And the first one is the competition for great ideas is really fierce. And so there's not really great ideas lying around all over the place and we just sort of pick them up. Over the course of the last 2 years, we'll have met with sort of over 1,000 different prospective investment ideas, and we funded 5 of those. So there's a lot of conversations that go into making an investment, and a lot of work that goes in. And at the exact same time that we're busy trying to find great opportunities, everyone else is too. And so it's sort of like the opportunity set never sleeps, the competition never sleeps, and every investment is not a good investment. And so spending a lot of time just making sure that we're being competitive and finding places where we can win. The second piece is that focus matters, and so we have a fantastic team, 4 investment professionals, 4 operations staff. We feel like we're well staffed and ready to invest on behalf of of all of our pools. But we can't do everything, and so we have to be very careful about how we spend our time and pick the places where we think that we can we have a competitive advantage. And so spend a lot of time trying to think about how we focus our energy on the right places. And then finally, more ways to win. It's always it's diversification really is a thing. Making sure that we have lots of ways to win across our investment pools is really important. And we always laugh as you stand back in any given year and you say, man, this was a really good idea. The reason why it's in the portfolio, the work that it does on behalf of the investments is really, really great, but that was a terrible return. And it just happens over and over where as you build out a portfolio, some things work and some things don't. And over time, you want everything to sort of work together as one sort of pool of capital to compound consistently over time. Competitive edge is really unchanged. We have a demonstrated success with governance. That means sort of the oversight and the relationship between investment managers, investment staff, and the investment committee, and the trustees is one of trust and a place where we can do the very best work. As I mentioned, full-time professional stewardship, and then staffed. We're staffed professionally. We have a very competitive team, and we think that we're in the right zip code to compound capital. So I'll step back, and we're going to sort of step back and look at a year. Again, a year is just one of many things, and so a year doesn't matter much, but we always like to provide an update on performance over a given period of time, and so we'll focus on a year. But this isn't last year. This is the year that ended in June 30 of last year. So this is now sort of 9 months ago, and this is essentially how the endowment reports. It reports by fiscal year, and so the most recent fiscal year ended June 30th of 2023. So going back in time, I'll set the context. So when we ended that particular fiscal year that we're talking about now, the public stock, so we think about the S&P 500 at alt, we're up about 16%. Bonds over that same period of time were down fractionally. And then inflation, which is a conversation that, of course, we have today, and it seems sort of normal to have. We didn't have that conversation for a long time, but inflation at 3% is a challenge and a new feature of the investment environment, which Gene will touch on in great detail. So the OU endowment in this context, the OU endowment earned a 6% return. It ended the fiscal year at $1.9 billion. And over the course of that year, we had $107 million of profit, both realized and unrealized. As you look at that number, it doesn't look like the stock number, although we own lots of stocks. and it doesn't look like the bond number. It's a mix of both, but one of the interesting features about sort of more ways to win and diversification, we have a handful of assets that would be called sort of things like private equity, venture capital. Those earned 0. Public markets did 16. Bonds did 0. And so when you put all those together in a portfolio, you ended up with a return that didn't look like stocks and it didn't look like bonds. And so we understand how we got that return. It's fine. In any given year, you wouldn't want to have that happen every year, but it makes sense. And if you sort of go back in time, one of the features of the market has been that these things like private equity, venture capital have been marked very aggressively. And so you generate a lot of that performance in previous years. And this year, in particular, those assets did not keep up with public markets. At the end of each year, we use our spending distribution formula, and we generate a number of which we send to the university for support. All of it is donor directed for their given needs. But nevertheless, last year we sent $60 million to the university's operating budget. And that is a record number in terms of overall support for the university. This year, we expect that number to grow to almost 70 million. So the OU endowment itself will generate a $70 million distribution this year. The overall pool, which includes the Regents funds as well, will spend about 84 million. It's kind of magic in the sense that if you think about putting together an operating budget and finding ways to pay for everything, you have students, which you could charge tuition. You have the state, which supports the university. Then you have a whole bunch of other sort of line items that you're always asking for. You sort of need somebody to give you money to fill the hole in your budget. And what's really remarkable about endowment distribution is that nobody had to ask for it. Every year it just sort of magically comes. And so it's really, of all of as you think about paying for the university, of all of the ways to pay for the university, this is probably the single way and the only way that the university funds itself without having to ask. They're not asking for tuition. They're not asking for a federal grant. This is an incredibly special source of funding for the university, and I think it should never be lost on us that this is really special. And so, as you look around, our endowment is incredibly large by dollar standards relative to other endowments. It can be quite small, and the benefit of, again, donors plus investment plus development plus time is that we expect this number to grow considerably and continue to compound the impact at the university. So very specifically, again, performance ending June 30th. This is sort of the league table. What we have at the top in red is the performance of the endowment over different periods of time. So for 1 year, 3 year, and 5 year. We could go out to 10 year, 15 year, etc. We have one of the benchmarks that we care about called the implementation benchmark. We have a second benchmark that really is the primary benchmark for us, which is our policy benchmark. And then we have a sort of aspirational goal, which is the amount we spend, which is 5.5% annually, plus inflation. So we would like each gift to grow and keep up with inflation. And I'll focus really on the bottom one, which is this was a really easy number to beat for a long time. And we had inflation of 8% 1 year, 3%, and it'll be somewhere around 3% again this year. And so 5.5% plus inflation at 3% means that you need to generate returns of 8.5% a year in order to maintain the real purchasing power of each gift. As you look back over time, 8.5% is actually a really big number. And you can typically only get there with uncertain cash flows. So things where you don't really know what the value is going to be, but you expect the cash flows to sort of work over time. That's a really cheeky way of saying mostly stocks. So, or sort of riskier bonds. There's really no way to get to an 8.5% return with assets that you would consider sort of safe sleep at night. The great news is that over time, Most of these assets with uncertain cash flows have actually generated great returns, but they haven't done it all at once, and there's been really scary periods of time. And so that is one of the outcomes of spending at 5.5% is that you have to sort of on the other side accept that some years that won't be very comfortable. And over the long period, over the next 100 years, that's going to work out really well for the university and its students. On the next page, we provide, and again, I apologize, this is hard to see, but just imagine that each of these bars it represents a different period of time. So from left to right, it's the sort of the most recent fiscal year. Then we have 3 years, 5 years, and 10 years. And we've asked the question relative to 150 of our university peers, all of the sort of big ones that you would know, as well as a handful of small ones. Relative that each, all 150 of those is packed in the gray bar, and we've separated out by quartile. So the best top 25, the middle, and the bottom 25 is essentially what's displayed here. And then the red dot is where the OU endowment landed relative to all of those peers. And so from left to right, last year was a little bit below average. You move to the 3-year, it was sort of average relative to peers. You move to the 5-year above average, and you move to the 10-year, and it'd be sort of top quartile. And so again, any 1 year is really not anything we think too much about. But our goal, despite the dot on this page, we just want to be in the upper half pretty much every year, and it will, in sort of the long term, will take care of itself if we can be above average over time. And historically, we've really been able to do that. How we invest, again, this is sort of a pie chart, obviously. It doesn't tell you much. Let me just go under the hood a little bit. On the right-hand side is our policy targets. So when we have a conversation with the investment committee, this is the conversation that we have. They sort of approve this as a general place where we ought to be. And what's under the hood changes over time. But the idea that this is roughly how we want to remain, our assets to remain allocated to compound over time, this stays pretty consistent. So from year to year, you won't see much change in this, although what's actually under the hood does change. Over the course of this year, there wasn't a tremendous amount of change. And so this chart looks very similar to what it did last year. I'll just go, we have a really sizable investment and commitment to private investments. So this would be all generally private equity, venture capital. About 30% of the portfolio is in private investments. 40% of the portfolio is just in stocks, just global stocks, things that you would recognize. And we measure that relative to broad. And is really what we call real assets. That's mostly energy related investments and some real estate. And then on the right is cash and bonds. And so that's about 15% of the portfolio today. So providing a portfolio overview is that's sort of the background. And I think the thing that I'm really excited to remind everybody about is both what's happening today and these sort of short-term measures and thinking about compounding exceptionally over time. And the second is, so what's the benefit of that? And so I want to take a moment to just say the opportunity again is donors plus investments plus development plus time equals profound impact. And I want to share with you a few charts on what profound impact looks like. So what is on this page from left to right is a question about the class of 2044. So if you show up on campus in 2044, and you ask a question about the endowment, this is how we'll answer. So for those who need a little help with math, that's 20 years from now. So this is time. If you think about this, this is not only beyond the careers of the investment team, this is beyond the tenure of all of the trustees. This is often beyond the tenure of the folks that will be leading and participating in the university. So this, our investment office will be staffed with the children of our investment team. So this is a long time into the future. And if you just say, we're going to spend 5.5, we're going to try to earn enough to cover that and preserve the real purchasing power with no inflows and consistent support for the university. On the left-hand side, we have the ending market value. So right now, our endowment is at 1.9 billion. The expectation would be from a modeling that's a sort of the average outcome or the median outcome is that we would have an endowment of about 2.2 billion. So a modest change. And along the way, on the right, we have cumulative distribution. So we'll have a $2.2 billion endowment in 2044. We'll have distributed and supported the university with about $1.5 billion. So we have 2.2 in the ground. We've supported the university with 1.5 billion of incremental budget. And we'll distribute about $93 million per year. So, that's remarkable in and of itself. And I think that the sort of the remarkable nature isn't the change in the endowment value. It's fairly modest. What's really amazing is that along the way, we also distributed 1.5 billion. So add excellence in investment. And believe it or not, excellence in investments over time, if you can, it always sounds low, but if you can add 1% to just our general benchmark over time, if you can do that consistently for 20 years, first of all, it's going to make you the best investment team in the country. And second, it's going to have profound impact. So in this case, we end that period of time. If you could invest with excellence and add 1% per year to your expected return, we would anticipate that the endowment would be 2.9 billion rather than 2.2. And over that period of time, we would have supported the university with $1.7 billion of support as opposed to 1.5. And our distribution for the class of 2044 would be 120 million. Then you get to the really exciting part, plus donors, plus development. And so what we have here is all the two previous charts. And the third one, the red bar here is if you could generate the policy return, you can have excellence in investing and add value, and you have excellence in development. And all of a sudden you start making, again, very material impacts on the operating budget and the support for the university. So the pool, we would expect that pool, and again, the development here is about 1% of the market value of the endowment each year. So that's, in this case, that'd be $19 million of endowed gifts this year as an example of how much we're sort of adding in. So this is not a particularly aggressive number. It's an amazing amount of gifts, but it's not, relatively speaking, we've generated much more than that over the recent years. So again, a really appropriate target here. And instead of ending at 2.2 billion, you end with an endowment of 3.6 billion. And along the way, you've supported the university with 1.9 billion of distributions, and you're now spending $147 million per year. $147 million per year is essentially what the allocation of the state is to the university today. So you have a chance over the course of the next 20 years, with constant effort and impact, we have the chance to not offset, but augment the operating budget in a way that is consistent with the state of Oklahoma, and would be a remarkable amount of support for the scholarships and the faculty of the University of Oklahoma. So that is I'll conclude my remarks with this, but I really do think that this is the most exciting aspect of what the foundation is trying to do today, by being dedicated to excellence in investing plus excellence in development. And of course, at the end of the day, it all depends on the generous support of the friends and alumni of the University of Oklahoma. I'm going to introduce Gene Lohmeyer. Gene is the Deputy CIO, so Deputy Chief Investment Officer of the investment team here at the foundation.
Make sure I can work this. Everybody hear me okay? Yeah, fantastic. Well, good morning, everybody. It is wonderful to be with you today. I'll spend about 15 minutes or so reviewing capital markets in a little bit more granular detail. So we'll begin with a quick review of the total returns of major asset classes We show in our exhibit here the returns of global equities, real assets, and fixed income in red, gray, and blue, moving left to right. In the top exhibit, we show performance for the most recent rolling 1-year period. And in the bottom exhibit, we show trailing annualized 5-year returns. So beginning with 1-year returns in the top exhibit, it's been a pretty favorable environment for equities, as Brad mentioned. We show here U.S. Equities outperforming developed international and emerging markets by 10 percentage points each. Referring to the right-hand side of the top exhibit, it's been a less favorable environment for fixed income. So the Bloomberg U.S. Aggregate Index has returned negative 1.5%, and long-dated treasuries have returned negative 12%. The culprit here is, of course, rising interest rates. So throughout this period, for context, the 10-year U.S. Treasury yield has increased from approximately 3.5% to 4.25%. Referring now to five-year returns in the bottom exhibit, U.S. equities have really been a positive outlier over this 5-year stretch. So we show here U.S. stocks delivering roughly twice the returns of developed international, and again, outperforming emerging markets by 10 percentage points. This information isn't shown here, but within emerging markets, China has been a significant drag on the index. So Chinese equities have compounded at around negative 5% over this 5-year stretch. Referring now to the middle portion of the bottom exhibit, within the real asset space, REITs have also been an area of underperformance. This is largely attributable to the poor returns of office real estate securities, which have compounded at around negative 9% over this period, which equates to a cumulative peak to trough decline of around 45%. We'll have some additional comments on office real estate a little bit later in the presentation. Here we show a measure called the City Economic Surprise Index. And as the name implies, the purpose of this is to describe the extent to which economic data points are coming in either stronger or weaker than expectations here in the US. And as you can see, broadly speaking, data have been strong relative to expectations since early 2023. The data on this slide is taken from surveys of Wall Street strategists and professional economists conducted by Bloomberg. So in the left-hand exhibit, we show the consensus forecast for GDP growth in the US for calendar year 2024. As you can see, the outlook for growth has improved significantly since mid-2023. The right-hand exhibit references a study of professional economists that asked them to sort of forecast the probability of recession over the next 12 months. So this measure also reflects a significant improvement with a reduction of recession probability from 60 or 65% as of mid-2023 to around 35% currently. With the improved growth outlook and performance of our economy, we've also seen a corresponding increase in inflation expectations. And that's reflected in market-based measures of inflation expectations, such as TIPS break even, which is shown in the left-hand exhibit here, as well as forecasts of inflation, which are referenced in the right-hand exhibit. Speaking of forecasts, this exhibit was taken from a study that was referenced in a recent Wall Street Journal article. So the black line in this exhibit refers to the Fed funds rate going back to 2004, so approximately 20 years. And the blue lines that are sort of shooting off of the black line are market expectations for the future path of the Fed funds rate at various points in time throughout the past 20 years. So one immediate takeaway here is that market participants are pretty bad at predicting the direction of interest rates. As an example, in 2008, market expectations called for the Fed to increase interest rates from around 2% at that point to 4% over the next year or so. The Fed actually did the opposite and cut interest rates all the way to zero. Then in 2009, market expectations called for the Fed to increase interest rates from 0 to around 2% over the next 12 to 18 months. The Fed didn't actually move off of 0 for 6 years, and the Fed funds rate didn't reach a level of 2% until 9 years later. So the general pattern here seems to be that market expectations are often directionally right as far as what the Fed's next move will be, but the timing and the magnitude of these forecasts can be way off the mark at times. Another thing to keep in mind is that although interest rates have increased significantly over the last couple of years, the level of interest rates today is extremely average by long-term historical standards. So we're showing data here going back to the late 19th century. Notably, there have been two periods where interest rates were extremely low and maintained at low levels for a prolonged period. The first was from 1933 to 1951. During and in the aftermath of the Great Depression. And the second was, of course, more recently from 2009 to 2017, during and in the aftermath of the global financial crisis. So one takeaway here is that unless there is some sort of large-scale crisis or severe recession, we will not see a return to the ultra-low interest rate policies that have defined most of the past 15 years. So one question that you might have is, if we believe that ultra low interest rates are a thing of the past, why wouldn't we think about holding less of our capital in stocks and allocating more to relatively safe sort of income or yield oriented assets? We'll start to answer that question on this slide. So the blue line here refers to a rolling 10-year average of interest rates in the US. And again, we're going back to the late 19th century here. And the area shaded in red refers to the extent to which investments in equities have outperformed that interest rate over rolling 10-year periods. So the fancy term for this is the equity risk premium. In other words, how much additional return or compensation have I received for taking on the additional risk of investing in stocks as opposed to parking my money in relatively safe savings instruments? So as you can see, the equity risk premium is negative occasionally, but broadly speaking, it's consistently positive. And in fact, has been positive in around 80% of rolling 10-year periods historically. So the big takeaway here is that while we are certainly seeing opportunities to invest in credit and other sort of income or yield-oriented strategies, we continue to be largely focused on equities from a longer-term perspective. And actually, to illustrate that point further, not surprisingly, the equity risk premium does vary over time, and it does vary with changes in the level of interest rates. So for instance, toward the left-hand side of this exhibit, we show the equity risk premium during very low interest rate environments being on the order of 10%. So investors have been very handsomely rewarded for investing in stocks during very low interest rate environments. The equity risk premium does diminish, according to or along with increases in the level of interest rates, broadly speaking. So, but nonetheless, the main takeaway here is that the equity risk premium remains positive even in relatively high interest rate environments. So, for instance, with interest rates on the order of 7.5% to 10%, the equity risk premium has averaged between 2.5% and 3% historically. So again, plenty of reasons to remain equity focused from a very long-term standpoint. So while we are very long-term focused and equity biased in our asset allocation, we do very carefully monitor capital market conditions and cycles. So the consensus outlook today is that inflation will come down in accordance with the Fed's long-term targets, and the Fed will lower interest rates sometime in the back half of 2024, and in doing so, engineer a soft landing. While we would welcome that outcome, at the same time, there are several sort of classic recession indicators that are flashing red that are difficult to ignore. One such indicator is the shape of the U.S. Treasury yield curve. Under normal conditions, long-term interest rates are higher than short-term interest rates. And this is necessary in order to compensate investors for reinvestment risk and interest rate risk. However, when the opposite is true, when short-term interest rates are higher than long-term interest rates, this is referred to as an inverted yield curve. And yield curves become inverted for a variety of different reasons. But one practical implication is that it undermines the profitability of banks, who have to pay an interest rate to depositors that is high relative to the interest rate that they receive on loans that they make. So this can cause banks to become more conservative in their lending activity and reduces the velocity of money in an economy and can contribute to an economic slowdown. So what we show here is that the yield curve is in fact inverted today and was also inverted either immediately prior to or during each of the past 5 recessions here in the US. Another data point worth keeping an eye on is the unemployment rate. So one thing that's interesting when you look at a time series of unemployment rate data is that it tends to exhibit very strong trend behavior, meaning that it's always going up or always coming down. So the fancy term for this is autocorrelation. And this happens because of feedback loops. So for instance, if you lose your job or you see several of your colleagues or neighbors lose their jobs, you're inclined to spend less money. So this reduction in spending is experienced as a reduction in revenue and earnings growth for companies who in turn lay off more employees as a result, and the cycle repeats itself. So in this exhibit, we're showing, well, in the left-hand exhibit here, we're showing in the red shaded areas, periods where the unemployment rate in the US has declined year over year, going back to 1960. And in the right-hand exhibit, the gold shaded areas refer to recessions. So I've arranged these exhibits side by side to illustrate the fact that year over year increases in unemployment have historically correlated very strongly with recessions. As of March 31st, we have seen, in fact, a year over year increase in the unemployment rate. So if we are not either in a recession currently or entering a recession, that would be historically unique in the sense that each of 9 such periods have historically coincided with recession. During our capital markets update at the 2023 forum, we mentioned that office real estate was a concern. This continues to be the case today. The story here is pretty straightforward. Even prior to the pandemic, the vacancy rate for office real estate was increasing. We all know what happened to the occupancy of office real estate during the pandemic. That trend has actually continued following the pandemic as vacancies have continued to climb, as you see in the exhibit on the left. We've also seen a significant decline in transaction volume and a corresponding increase in the delinquency rate on office real estate loans. So far, the impact of this on financial markets has been relatively contained, but I'm inclined to think that this becomes a bigger problem to the extent that we have any sort of meaningful economic slowdown. Finally, the last thing I'll mention is fundraising within venture capital. The story here is also pretty straightforward. So in the right-hand exhibit, the red bars refer to the median internal rate of return for venture capital in vintage years ranging from 1990 through 2022. And the blue line refers to the amount of capital raised in each vintage year. So the upshot is that extreme highs in fundraising for venture capital have historically coincided with below average performance. For example, from 1990 through 1997, the median internal rate of return for 7 of 8 vintage years was greater than 20%. So this was a sort of golden age for venture capital. Fast forward from 1998 to 2008, the median return, so I should have mentioned, in the first period reference from 1990 to 1997, the average amount of capital raised by the funds in this database was about $3.5 billion per year. So fast forward from 1998 to 2008, the average amount of capital increased to about 19 billion, so around 5x the amount. And for each of these 11 vintage years, the median IRR was less than 10%. And for 9 of these 11 vintage years, the average return was less than 5%. So investors were not well compensated. I would say not even appropriately compensated for taking venture capital risk over this 10-year stretch. So this is something that we have our eye on in the sense that recent fundraising activity in venture capital has followed a similar pattern and has resulted in a sort of an overhang of capital that will cause us to be much more conservative in this area going forward. So that concludes the update. I should mention I sound a little downbeat today. when we think about and talk about issues like office real estate and fundraising and venture capital, the goal is not to try to time the market or make bold predictions, but really just to be careful and deliberate and thoughtful of the types of risks that we introduce to the portfolio and how and when we do it. For what it's worth, as far as allocating to these types of investments, we have allocated less than we'd planned to over the last few years, and less than we were permitted to by our investment committee. And frankly, we feel great about that. We're inclined to be patient and wait for the right moment and the right opportunity to add risk to the endowment. We feel like we have unutilized risk capacity at the moment, and we look forward to using it at the right time. But the overarching message should be that we're being very careful with the work that we're doing. So that concludes my part of the presentation. Thank you very much. I think we'll move to Q&A.
Okay. I'm going to guess that we can have a slide that now we can open it up to questions and answers. Well, at least questions. Make no commitment on answers. We'll see about answers. My colleagues, of course, are available to answer questions, but I'll MC this process if that's okay with everyone. So I'll open it up to questions. Jana will hand you a mic just so that we can hear each other and the questions, but we're also streaming this, and so we want to make it available to the folks online. Questions? Yes, sir.
Go back one slide.
Oh, this feels like a Gene question.
The chart on the right that shows it kind of looks like the internet boom went up, venture capital raised right at the year 2000 and then went bust. Does that have any significance to the AI, the artificial intelligence that's being raised now, and the negative yields?
Do you understand the question? So are we in the beginning of another bust relative to a boom?
You never know, but the setup is very similar. And the pattern tends to be that investors get really excited about new technologies, whether it's railroads, electricity, the internet. We overestimate the timeline to implement those technologies and to monetize those technologies. And it winds up, the result that people are anticipating winds up taking, 15 to 20 years. It winds up happening, but taking much longer. And markets front run that, and there tend to be excesses that work themselves out over time. So I think it's a byproduct of human nature. And if you've been in this business long enough, you've seen examples of it. And there definitely are some parallels. AI itself is unprecedented, though, and it could be an enormous productivity miracle. So we are involved, but in a very, very measured way.
So more doom and gloom from Gene. He's generally a very happy guy, I got to tell you. Other questions? Oh, I'm sorry, Terry.
Brad was talking about the 1% excellence over benchmarks.
Mm-hmm.
Where's Brad and Gene going to get that?
That is what they spend almost all day doing. Because it's, and Brad sort of implied this, but that's the goal, is to beat our benchmarks by 100 basis points. And if we can do that annually, obviously it produces an incredibly powerful outcome. But do you want to take a stab at it? The answer is it moves around. That's what he's going to say.
Yeah, that's exactly right. And there's a pretty famous sort of display of how this game works, and the industry refers to it as a quilt chart. But just imagine that you ask the question, and each year, you sort of years are at the top, and they're columns, and then you ask the question, which asset class did good in each year, and sort of each asset class has its own color. And you look at the chart and you're like, there's just like, it's everywhere. And one of the funny things is the thing that did worse last year did the best, the next year. And it's just sort of, if you just bunch asset or opportunities, investment opportunities in groups, it moves around. And so that's the easy answer. From our side of the table, we're trying to do it a little bit more carefully. And so the first question is sort of how much money do we have to invest in these kinds of things? And then is this an interesting space or not? And so for us to spend time in something like sort of buyout private equity, which is a special kind of private equity, for us to spend time in that, it takes literally years of relationship building, research, diligence to sort of get to know who's in the space and what the opportunities are. And so while what does well jumps around all of the time, our priority is to find a handful of things that we think have really attractive long-term moats that we can spend tons of time on and we can deploy a lot of capital. So when we see that chart of things jumping around all the time, we really don't worry about it too much. What we worry about is the thing that we're spending our time on, the time that our team is spending. Is that going to be a durable opportunity that will last for several years, if not decades?
I think one of the things that is sort of true about Brad and Jean's work is that and it's obvious, we have a fixed amount of capacity that we can throw against answering questions or solving problems. And so there's this constant prioritization of where their team allocates time relative to what the expected return will be. And because of the length of time that it takes to make a substantial commitment to an individual manager, but which in the context of a commitment to an asset class, for lack of a better term, a space for investing, it's not a 30-day process. It's years, as Brad said. And so, and the good news is, this is the best news. We're investing the endowment in perpetuity. And so we really don't have time horizon constraints. And so we can commit that kind of time and that kind of thoughtfulness to our process, and sort of not completely, but sort of ignore what's going on today, because it'll change, and good will be bad and bad will be good. And by the time we get to it, our goal is to be persistent. Other questions? Brian, I'll repeat the question if you want to get started.
This question's really for Amy, and thank you for the pages on student support. Question is, the 2 pages on student support success, are those based on the fiscal year ending June of 23? And if so, can you give us a kind of a more defined update post that, or are they based on a calendar year?
I think let's make sure we're talking about the same slide. I think we're talking about the slide in which we talk about the 4 colleges in which we've seen some success, or Davis Cup and enrollment management.
Really, it's the page showing the 500 million commitment to students since the start of the campaign, and then student support success 63.5 million. I guess, is that since the beginning of the campaign? Because you had talked about you're kind of way ahead for goals for additional dollars on the page you referenced.
Exactly. So the number that you're talking about, where our goal for the campaign for student support is 500 million, and we're at about 260 today. It includes all 3 years, 3.5 years at this point of the campaign. Where we're at this year, gosh, I should know this. Is it 56 million today? We get a daily report. So I'm looking at somebody in my team. Where are we at today on student support? J-Con. I'll tell you where we're at. And it's important because 66.1 today already in this fiscal year. And I think last year we were at 30 something. So that's why I was suggesting to you this year we've seen an increase. And I would say a greater focus on that, and we're seeing that number rise. That's why I think those last couple of years of the campaign are going to continue to go up. If you'll remember in that last slide I showed, fiscal year 27, our goal is to get to 100 million a year in student support. And so last year we were in the 30s. This year we're already at 60. So we anticipate that to continue to grow just a little bit over these last 45 days of the fiscal year. But yes, that's where we're at. Does that answer your question? Okay. Thanks.
Yes, sir. Oh, sorry. She handed him the microphone. I have no choice.
Several years ago, at one of the forums, you mentioned that the future rates or distributions were going to be gradually stepped down from 5% to 4.5%.
Yep.
For the report that we saw for FY23, there was about $60 million distributed on a 1.9 billion, which comes out to about 3%. So I thought you had mechanisms in place so that in a year when the returns were modest, you could still distribute that 4.5%. Could you have someone comment on that, please?
No, sure. And I can handle that question. So, in addition to the distribution rate, which we did step down to 4.5%, and I would say proudly, despite that, in each successive year after we stepped it down, we've distributed more money to the university. So as a percentage less, but in total dollars more. But in addition to that rate, there's a smoothing process that we apply that averages the prior 12 quarters net asset value. So you never get a number that's exactly 4.5. Well, you don't never. You could get a number that's exactly 4.5% of the current value, but it's 4.5% of the average of the prior 12 quarters. And so if you have a period of time where the assets increasing at a fairly healthy rate, that endpoint is much higher than the average of the prior 12 quarters. So you don't get a full 4.5% of that year's ending net asset value. So, oh boy, I know. Does that make sense? The math is 12 quarter moving average. Sometimes that's above the current asset value. Sometimes that's below the current asset value. It just depends on what the trend line on the asset value of the pool has been. So we distributed 4.5% of the 12 quarter moving average. Oh, yes, sir. Eddie.
Where do you see commodities just in general relative to the stock market? Where do you see commodities relative to the stock market returns forward? I mean, what's your kind of crystal ball? And I guess, can I ask two questions at once? Maybe related. Where do you see the U.S. dollar heading? And is there a related debased risk in any of your thoughts? Not to be gloom and doom here, but
I'll let
anyway.
Brad stand up. I can
Two questions in one.
I'll protect him from the answer to this question, Eddie. You know, he's famous for saying we have no earthly idea what anything's going to do. We have, is that fair, Brad? I'm not. Yes, right. It's a direct quote, made many times. The fact of the matter is we don't predict anything relative to any of the markets, commodities or dollar value. I mean, you could have some sense if we're in inflation, in a generally more inflationary period, that commodities might do better, but that doesn't inform our investing. So is what I would say. Now, these guys would have a perspective, Gene in particular, about where some of those things might go. But if you guys want to take a stab at that and violate your own principle.
Great. As Guy indicated, we don't make decisions predicated on a view necessarily. The one thing I'll say is you do periodically hear accounts of the dollar losing its status as the world's reserve currency. That simply isn't happening. The world is becoming more fragmented politically, but just in terms of the various KPIs or indicators that you would look at to see whether entities are changing their reserve currency utilization, it's just not happening. As it pertains to commodities, one of the things that has happened in the U.S. Is that our economy has become less natural resource intensive believe it or not, as we've become more service oriented. So you used to have these really dramatic, cyclical swings in commodity prices resulting from, shifts in the economy. That's been muted. It's been muted in part because of the more idea and service oriented economy that we now have, but also we have the equivalent of just-in-time delivery of hydrocarbon because of horizontal drilling. That has really, and we are the swing producer here in the U.S. So those dynamics have created more stabilization in commodity prices over time. So even if we were in the business of thinking really hard and trying to anticipate currency and commodity movements as part of our investment positioning, I don't think either would feature prominently.
Brad touched on this, and Gene even more so. Our beliefs about investing are sort of center on the notion that that time is our friend, not our enemy. For a lot of investing, time is a bigger challenge. That we'd prefer to own assets rather than be a lender to asset owners. We've got lots of data to support the notion that that's a winning strategy over a long period of time, and that we believe in the economic system of the U.S., which biases our investing in equities and things where we own things more in the U.S. than other places. Those are the principles that guide us. The rest of it's sort of interesting, and we end up talking about it quite a bit, but doesn't necessarily inform our investing. Any other questions? If not, well, I want to thank you all again for coming. We enjoy being together, and we really enjoy sharing kind of what's going on at the foundation and the results that we have. We're 100% committed, obviously, to the successful future of the University of Oklahoma. We get up every day and think about that and work on that. And we know that we couldn't have any success in doing that without all of your support. So thank you for that. I'd like to also thank the Gaylord College of Journalism for hosting us. This is a terrific space. And so to the degree there are any Gaylord people here, thank you, thank you, thank you. And we wish you a dry and happy rest of your day. Oh, one more last week. I don't think we set that up. I'm looking at Jana, which is terrible to put her on the spot. I don't know, Jana.
We have not, but I bet it would not be hard.
Yeah, we could probably rally a little to her. So that's a great idea. Wish we'd have thought of it. So again, thank you. Oh.
I'd like to compliment you on your slides, the way they're presented. It's great.
Thank you for that. Thank you. Thank you. These guys work really hard on it. And Jana's team as well. So thank you all again.